Welcome to this explainer. Okay, so we interact with money every single day, right? But today, our goal is to uncover the massive, dynamic, and honestly sometimes completely invisible system that governs the cash sitting right there in your wallet. The underlying mechanisms of how money is valued, measured, and literally created by our banking system are truly mind-bending once you pull back the curtain. Let's kick things off with a brilliant question that actually popped up on a UPSC civil services exam. Imagine you withdraw 1 lakh rupees in cash from your demand deposit account at your bank. What is the immediate effect on the aggregate money supply in the economy? Does it shrink? Does it grow? Well, the answer is a resounding no. It leaves the aggregate money supply completely unchanged. No way, right? But it's true. Because as we'll soon see, the money supply includes both the currency in your pocket and the demand deposits in your bank. Moving it from one to the other, it doesn't change the total sum at all. This little paradox leads us perfectly into our exploration of how money truly works.
So let's dive right into this. Here is our 4-step roadmap for today. First up, the demand for money. Second, measuring the money supply. Third, how banks create money. And finally, central banks and monetary policy.
Starting off with Section 1, the demand for money, why we hold cash. Think about your own individual motivations for a second. Why keep physical money on hand rather than investing every single penny you own? To understand this desire for cash, we have to talk about liquidity. Liquidity is simply the ease or the speed with which an asset can be converted into cash without losing its value. Cash is the absolute ultimate liquid asset. I mean, you can't buy groceries with a fraction of a house, right? Back in 1936, the legendary economist John Maynard Keynes published his general theory. And in it, he proposed the liquidity preference theory to explain exactly why we crave this highly liquid cash. Keynes argued that our demand for money is basically driven by 3 specific motives. First, there's the transactionary motive. We just need cash to pay for our daily bills, buy groceries, keep the lights on. Second is the precautionary motive. Keeping a stash of cash for sudden emergencies, like an unexpected medical bill or a broken-down car. Now, both of these motives are what economists call perfectly interest inelastic. That just means it doesn't matter if your bank is offering 2% interest or 10% interest, you still need to pay for your groceries, and you definitely still need an emergency fund. You're going to demand that money regardless of the prevailing interest rates. But the third motive, the speculative motive, that operates very differently. What's really interesting about this is the inverse relationship it relies on. Keynes assumed people hold wealth in 2 main ways, cash or bonds. Now, bonds pay a fixed amount of interest, so mathematically speaking, if the price of a bond is high in the market, its effective interest rate is actually low. In that scenario, there's a really low opportunity cost to just holding cash, so people sell their bonds and hold on to more cash, basically waiting around to speculate on future changes. Conversely, when bond prices are low, interest rates are high, so people buy bonds to chase those juicy returns, draining cash right out of their pockets. This constant dynamic pushes and pulls the demand for money across our entire economy. All right, moving to Section 2, measuring the money supply, from base to broad. So, we've zoomed in on individual demand, now let's zoom out to the total supply. In the simplest terms, there are really 2 types of money. We have central bank money, denoted as M0. This is the monetary base. We're talking direct obligations of a central bank, like the physical currency notes out there in circulation. But then we have commercial bank money, denoted from M1 to M3. This is where money expands into that vast digital trust-based system managed by everyday commercial banks through your savings and current accounts. To track all of this, the Reserve Bank of India publishes what are called new monetary aggregates. Let's walk through them. Starting at the absolute base, we have NM0, or reserve money. This is strictly currency in circulation and deposits held directly at the RBI. Stepping down to NM1, often called narrow money, we add the public's currency and their demand deposits. Yep, those are the checking and savings accounts we mentioned in that UPSC question earlier. Moving to NM2, we add short-term deposits. And finally, we reach NM3, known as broad money. NM3 is the big one. It captures the complete balance sheet of the banking sector, including all those long-term fixed deposits. So when economists really want to know the true money supply out there in the economy, NM3 is the gold standard metric they look at. Section 3. How banks create money. The multiplication magic. Okay, this is where things get wild. Commercial banks actually create money through a concept called fractional reserve banking. It's essentially multiplication magic. Let's trace the physical journey of a single coin. Step 1. You deposit your cash into your bank. Step 2. The bank doesn't just lock all your money in a vault. By law, they only have to hold a small fraction of it as a reserve. Step 3. They lend the rest of your deposit out to someone who wants to, say, buy a car or start a new business. Step 4. That borrower spends the money, and whoever sold them that car takes the cash and deposits it right back into the banking system. And boom, the cycle starts all over again. A single deposit physically breathes new credit money into the economy over and over and over again.
So the crucial point here is that mandated reserve ratio. Let's just say that ratio is set at 10%. That means commercial banks are only legally required to keep this tiny 10% fraction of your initial deposit completely safe in their reserves. They are entirely free to turn around and lend out the remaining 90% into the broader economy. To put that into perspective, let's look at the math, because it brilliantly illustrates the reality of the money multiplier effect. If you deposit $1,000 and that reserve ratio is 10%, the total money created in the broader economy isn't just your original $1,000. It's $1,000 multiplied by 1 divided by 0.10. That means your single $1,000 deposit cascades through the banking system's lending cycles to mathematically create $10,000 of broad money. It's a spectacular, almost unbelievable system of expanding credit.
Section 4. Central Banks and Monetary Policy. The Puppeteers. So who's actually pulling the strings of this entire multiplication process? We need to be very clear about the division of labor here. While commercial banks are the engines of credit creation, taking in deposits and lending them out to expand the money supply, they definitely do not set the rules. The central bank, which for us is the Reserve Bank of India, completely controls the base money. They issue the primary currency, and crucially, they set that reserve ratio and the foundational interest rates. Essentially, they hold the leash on the commercial banks. And this oversight translates into highly actionable policy. The RBI operates through a 6-member Monetary Policy Committee, or the MPC. This committee has a strict legal mandate to maintain a consumer price inflation target of exactly 4%, with a little wiggle room of plus or minus 2%. To hit that target, they adjust the policy repo rate, which ripples out and influences interest rates across the entire economy. On top of that, they maintain a bank rate. And what's interesting here is that while the bank rate used to be for long-term refinancing, today it acts primarily as a penal rate. It's basically a penalty charged to commercial banks if they mess up and fail to maintain those required reserves we just talked about.
To wrap up our explainer today, I want to leave you with a bit of a provocative thought, bringing us right back full circle to John Maynard Keynes. Are we ultimately just trapped in the illusion of money? You see, Keynes warned of something called the liquidity trap. It's this theoretical nightmare scenario where interest rates are already so incredibly low that the speculative demand for money becomes perfectly elastic. In this trap, the central bank can pump as much new base money into the system as they possibly want, but people just hoard the cash. Interest rates simply refuse to drop any further. It's a powerful reminder that while the mechanics of money supply and central banking are absolute juggernauts, human behavior and our deep-seated desire for liquidity ultimately rule the market. Thank you so much for joining me on this journey through the world of money and banking. I bet you'll be looking at the cash in your wallet in a completely different light from now on.